Welcome to the Deep Dive. This week, well, we're diving deep into a period that really could redefine foreign exchange markets.
Yeah.
We seem caught in this fascinating tension, don't we?
hmm
On one side, you've got this backward-looking economic data hinting at maybe some fragility.
Right. Things that have already happened.
But then the forward-looking policy signals, they're bracing for potential inflation. It feels like a real tug of war for global currencies.
Absolutely. And our mission today really is to cut through all that noise for you. We're working from an in-depth global FX macro analysis report as our guide here.
Okay.
And we're going to try and pull out the most important nuggets of knowledge, maybe uncover some surprising facts, and help you prepare for what could be, well, significant market volatility this week.
So what's really at the heart of this, it sounds like the U.S. Federal Reserve's actions are the primary catalyst.
Right.
We're talking specifically about their preferred inflation measure, the core PCE, and of course, Chair Powell's, highly anticipated semi-annual testimony.
And always a big one.
So settle in, because this week looks ripe for volatility breakouts, maybe major shifts in currency performance, especially as economic momentum seems to be diverging globally.
Yeah, that divergence is key.
Okay, let's unpack this. The main event, the Fed's tightrope walk. First up is that U.S. core PCE price index for May. It drops this Friday, June 27th, 8:03 a.m. EST.
Right.
And just quickly for anyone newer to this, PCE is personal consumption expenditures. It's the Fed's absolute go-to inflation metric.
Yeah, they prefer it over CPI, for instance. It's broader, adjusts for how people actually change their spending.
But it directly impacts future monetary policy decisions.
It's
Big deal.
Huge deal. And what's truly fascinating here, what we're calling the asymmetric trap, is this divergence in expectations.
Okay, asymmetric trap. Tell me more.
Well, market consensus, it anticipates a pretty modest plus 0.1% month-over-month increase. The year-over-year figure cooling to 2.5%. It sounds fairly, benign,
That
right?
seems okay, yeah.
But the Fed's own forecasts are significantly higher. Their year-end 2025 core PCE median was just revised up to 3.1%.
Wow, okay.
And even the New York Fed's DSGE model, that's a pretty sophisticated forecasting tool they use.
Right, the equilibrium model.
Exactly. It projects an even higher 3.4% for the fourth quarter year over year.
So if the market's thinking cool, but the Fed's forecasting hot, where's the trap?
The trap is that the market might be, lulled into a sense of calm by the backward-looking data, the stuff we already know.
Right.
Well, the Fed, they're already looking ahead. They're thinking about the future impact of things like, say, anticipated tariffs.
Ah, okay.
And they're preparing for a much different, more inflationary reality. This creates a highly asymmetric risk profile for the U.S. dollar. Risk isn't balanced.
I see. So what does this mean for you listening? A soft number, say 0.1, might just get dismissed by the Fed as temporary noise.
Exactly. They might just shrug it off.
But any upside surprise, even just 0.2% month over month.
That would powerfully validate their concerns. It
Wow.
could force markets to fully price out any, remaining chance of a July rate cut.
And what does that mean for yields?
You could see a significant jump, maybe plus 5 to 7 basis points in the U.S. two-year yield relative to German or Japanese bonds,
Okay.
making the dollar carry trade much more attractive. A stronger surprise, say 0.3%, you could see maybe even plus 10 basis points or more, a really dramatic shift.
And connecting this to market positioning.
Well, speculative positioning in the U.S. dollar index, it's nearly flat right now, just a marginal net short.
So not many people betting heavily one way or the other.
Exactly. Which means there's significant dry powder, untapped capital ready to fuel a strong directional move if the data surprises.
Give me an example.
Well, a plus 0.2% print could trigger a really rapid immediate drop in Euro USD, maybe 50, 60 pips.
Okay, and for those unfamiliar, a pip is that tiny unit of price change in a currency pair. So 50, 60 pips is a noticeable immediate move.
It is, yeah, especially right after the data release.
Okay, this is where it gets really interesting. Next up, Fed Chair Powell's semi-annual congressional testimony, Tuesday, June 24th, Wednesday, June 25th, 10:00 a.m. EST.
This is pure policy signaling, a masterclass, usually.
His 2 days of testimony, they're a crucial exercise, but it's those unscripted Q&A sessions, right? That's where the real risk lies.
Absolutely. That's where you can get the unexpected comments.
And this raises a big question. How is he going to address that Q1 GDP contraction? Minus 0.2%.
Yeah, the market widely sees that number as distorted, likely due to businesses front-loading imports ahead of potential tariffs.
Right, so the headline number looks weak, but maybe it's not the full story. What should we be listening for then to get his real message?
Exactly. What you need to listen for is if Powell kind of dismisses that headline weakness
Okay.
and instead emphasizes the strength of underlying domestic demand. There's a measure, real final sales to private domestic purchasers.
Right. A better gauge of underlying private sector activity.
Precisely. That actually grew a healthy 2.5% in Q1. If he highlights that, it will be interpreted as a distinctly hawkish signal,
Meaning?
meaning the Fed isn't worried about an imminent recession. They remain squarely focused on inflation.
Okay. So if he sounds confident about underlying demand, despite the headline GDP dip, what's the implication for currencies?
Well, that kind of message would reinforce the Fed's hawkish resolve. It would firm up the front end of the U.S. yield curve, meaning short-term U.S. rates would likely stay high or go higher.
And provide a strong bid for the U.S. dollar.
Definitely. Particularly against currencies like the Japanese yen and the euro, where the central banks are, let's say, more dovish right now.
And this reinforces a risk-off tone.
Typically, yes. You likely see the VIX higher, that's the CBOE volatility index, the fear gauge, and you'd see classic U.S. dollar strength driven by that sentiment.
Okay, let's zoom out now. The global divergence story, moving beyond the U.S. focus.
Right, because it's not all about the Fed.
Exactly. Monday, June 23rd, early morning for the U.S., 3:30 a.m. and 4:00 a.m. EST. We get the Eurozone and Germany HTOB flash PMIs for June.
Okay, these are key. Purchasing Managers Indexes, HTOB is Hamburg Commercial Bank who compiles them. First, significant look at June activity in Europe.
And what are they showing? You mentioned divergence earlier.
Yeah, what's striking here is what we're calling Europe's Achilles heel, a concerning divergence. Manufacturing is showing some, let's say, fragile stabilization,
Okay.
partly maybe due to that tariff front-loading again, but the larger and really critical services sector has actually weakened. It seems to be slipping back towards contraction.
So a two-speed economy with services dragging, that's not great.
Not ideal, no.
Yeah.
Especially since services are such a big part of the Eurozone economy.
And this directly impacts the euro.
Oh, absolutely. A continued slide in that services PMI forecasts suggests it could dip right to 50.0, the line between expansion and contraction.
And below 50 is contraction.
Exactly. A reading below, say, 49.5 for the Eurozone services PMI would be particularly worrying. It would reinforce the case for a more dovish European central bank.
Widening that negative policy rate differential against the U.S. dollar?
Putting downward pressure on the euro, yeah.
Yeah.
And it could also trigger capital flows into safer assets like the dollar.
So for traders looking at this,
Well, if the German HEOB services PMI, which comes out first, prints below 49.0, that's often a strong leading indicator for a weak overall Eurozone print later.
and that could be a signal.
Could be a signal to consider shorting Euro-US, maybe targeting around the 1.1455 level, for instance.
Okay. Moving across the Atlantic, Tuesday, June 24th, 8:30 a.m. EST, Canadian CPI for May.
Right. This one's critical for the Bank of Canada, and frankly, a bit unpredictable this time.
Why unpredictable?
Two complicating factors. First, there's a noticeable divergence in analyst forecasts. Consensus is around 1.5% year over year, but some major Canadian banks like RBC, they're projecting 1.8%. That's a decent gap.
Okay, unusual disagreement.
And second, there's a concurrent basket weight update happening with this release, which can sometimes add a bit of noise or unexpected shifts.
So this discrepancy, it creates what? An opportunity.
A significant asymmetric opportunity, potentially, because the market might be positioned for that softer consensus number, the 1.5%.
Meaning a surprise to the upside would have a bigger impact.
Exactly. An upside surprise, say it prints 1.8% like RBC expects, that would be a major hawkish surprise. It would force a rapid repricing of the Bank of Canada's expected policy path.
Giving a boost to the Canadian dollar.
A significant boost, potentially. You could see a swift move in USD CAD, maybe a 60 to 80 pip drop.
So how might you approach that trade-wise?
Well, if the headline CPI prints at 1.7% year over year or higher, one idea might be to consider a pending sell stop order on USD CAD, just below where it was trading before the release.
Aiming for?
Aiming for maybe the 1.3650 to 1.3665 support zone down below.
Got it. Okay, let's head down under. Wednesday, June 25th, late evening in the U.S., 9:30 p.m. EST, we get the Australian monthly CPI indicator for May.
Right. Now, the Reserve Bank of Australia, the RBA, they've already been one of the more dovish G10 central banks.
G10 being the group of 10 major industrialized nations, they cut rates in May, right?
They did. And the market is already pricing in about a 75% chance of another 25 basis point cut in July.
So the Aussie dollar is vulnerable here.
Definitely highlights its vulnerability. With the market already heavily priced for more easing, a print that comes in line with or even below the 2.3% consensus.
Which is already quite low.
Right. That would pretty much solidify the case for a July cut, keeping downward pressure on the Aussie dollar.
And the AUD is often seen as a risk-on currency.
It is. It tends to do well when global markets are optimistic, poorly when they're nervous. So a weak domestic inflation print makes the AUD even more vulnerable if we're in a global risk-off environment, like the kind Powell's testimony might trigger.
So the move here.
Well, if that CPI reading comes in at 2.2% year-over-year or lower, that looks like a strong trigger to consider shorting AUD-USD, especially if global risk sentiment is sour.
Any other angles?
You could also consider shorting AUD-JPY. That pairs a dovish RBA with a potentially, as we'll discuss, more hawkish Bank of Japan down the line.
Okay, perfect transition. Japan, Thursday, June 26, 7:30 p.m. EST, Japanese Tokyo CPI for June.
Yes, this is Japan's most timely inflation indicator. It's watched very closely as a reliable precursor for the nationwide CPI figure that comes out later.
And the Bank of Japan, still broadly dovish.
Fundamentally, yes. They've ended negative rates, but they're still very cautious. So this data is crucial for any hints about future policy.
So what's the potential catalyst here for the yen?
An upside surprise in the Tokyo CPI, particularly in the core measure. That's the one stripping out fresh food and energy, giving a cleaner read on underlying trends.
What would that signal?
It would directly fuel market expectations that the Bank of Japan might actually be forced to hike interest rates again, maybe later in 2025.
Which would narrow that massive negative interest rate differential with the U.S. and others.
Exactly, providing fundamental support for the Japanese yen, which has been under pressure for so long because of those differentials.
That sounds like a potentially powerful trade setup. What could happen?
Well, an upside surprise could trigger a pretty painful short squeeze in USD-JPY.
Explain short squeeze quickly.
Sure. It's when investors who have bet on the yen falling by being short JPY or long USD-JPY are forced to buy yen back quickly to cut their losses when the price moves against them. This buying pressure drives the yen price up sharply, or USD-JPY down sharply.
And there's a lot of historical short yen positioning out there.
Typically, yes. It's been a popular trade, so even a 0.2% beat on that Tokyo CPI could lead to a rapid drop in USD-JPY, maybe 40-50 pips pretty quickly.
So, trade ideas.
You might consider a long JPY position against a more dovish currency, like the Aussie dollar we just discussed, so short AUD-JPY, or maybe a tactical short position on USD-JPY itself, perhaps aiming for a move back towards the 145.000000000000.
Okay, lots to watch there. Now let's quickly cover some secondary U.S. data, still important details, right?
Yeah, they add color to the picture. Tuesday, June 24th, 10:00 a.m. EST, U.S. CB consumer confidence for June.
Now, the University of Michigan Sentiment Survey recently had a strong rebound. Does that set a high bar here?
It potentially creates a bit of a trap for market expectations, yeah. The consensus for this Conference Board report is more modest, just an increase to 99.1.
So, contrarian play, maybe?
Potentially. If the CD index fails to confirm Michigan's optimism, if it prints flat or even down, say, below 98.0, that would challenge this emerging narrative of a resilient U.S. consumer.
Which would be negative for
U.S. economic outlook and therefore the dollar.
Yeah.
It could offer a tactical short USD opportunity, perhaps against a currency showing recent strength like the Canadian dollar maybe.
Okay, then Thursday, June 26th, 8:30 a.m. EST, U.S. durable goods orders for May.
Right. This report is notoriously volatile. Big aircraft orders swing the headline number all over the place.
So ignore the headline.
Pretty much.
Yeah.
The key is to focus on the numbers excluding transportation and especially non-defense ex-aircraft, what analysts call core CapEx. That gives a much cleaner read on actual business investment trends.
And what are we looking for there?
Subtle signals.
Right.
A miss on those core figures, even if the headline beats because of Boeing orders or something, that would signal a genuine weakening in business investment intentions. That's a negative leading indicator for the economy, a dovish signal for the Fed. It's probably better for informing your overall view rather than setting up a specific high-conviction trade.
Makes sense. Also on Thursday, same time, 8:30 a.m. EST, the final U.S. Q1 GDP print.
Yeah, third estimate, so it's lagging data, looking quite far back now.
But revisions still matter sometimes.
They can. Revisions to key components like that real final sales to private domestic purchasers figure we mentioned earlier, currently at plus 2.5%, can still provide some insight.
What's the underlying story here?
Well, the narratives that the Q1 contraction was just an anomaly driven by imports, that's pretty well established now.
Okay.
However, if there was a further downward revision to real final sales, that would challenge the strong underlying demand story that the Fed hawks like to point to.
So it could subtly undermine the dollar.
Could subtly undermine the USD, yeah.
Yeah.
Especially right before the really critical PCE inflation data comes out on Friday.
Got it. And one more. Early Friday, June 27th, 2.000 a.m. EST, UK final Q1 GDP.
Right. Now, the preliminary Q1 GDP number for the UK was surprisingly strong, plus 0.7%.
But there were doubts about its sustainability.
Big doubts. Both the Bank of England and many analysts questioned whether that strength would last.
So this creates what kind of risk for the pound?
An asymmetric pound risk, really. The market has largely embraced that robust initial print.
Okay.
But any downward revision, say back down to plus 0.5% or even lower, would significantly undermine the bullish case for sterling.
Triggering a correction.
Could trigger a sharp correction, yeah. And it would increase expectations for Bank of England rate cuts later in the year.
And the signal there?
If that happens, it could be a signal to consider shorting GBP USD, maybe targeting down towards the 1.3400 level, perhaps.
Okay, wow. We've covered a lot of ground there. Let's try and synthesize this. As we wrap up, what's the highest conviction play you see this week?
Looking at everything, the setup that seems most compelling is probably long USD JPY.
Okay, why specifically?
It really comes down to that widening policy divergence we discussed.
Yeah.
You have a Fed leaning hawkish, partly because of those tariff-related inflation risks they see coming,
Versus AUKA.
versus a Bank of Japan that remains fundamentally dovish, even if they might hike eventually. And importantly, that flat speculative positioning in the dollar suggests the market just isn't fully prepared for a scenario where U.S. rates stay higher for longer and Japanese rates remain very low.
Underprepared for that divergence trade.
Okay, so the overarching strategy for the week then,
I'd frame it as positioning for asymmetric USD upside.
meaning the risk-reward favors dollar strength?
Exactly. That clear divergence between the market's somewhat benign consensus for near-term inflation versus the Fed's own explicit forward guidance and forecasts. It means the risk-reward seems skewed towards USD strength.
So a hawkish surprise hits harder.
A hawkish surprise from either the data, like PCE, or the rhetoric, like Powell's testimony, is likely to have a much larger market impact than just a soft inline reading would.
Makes sense. What's the main risk to that view? What could derail the long USD idea? The principal risk, really, would be a significant and unexpected dovish pivot from Chair Powell during his testimony.
How might that happen?
If he suddenly started emphasizing growth risks much more strongly over inflation concerns, for example, if he sounded genuinely worried about a slowdown,
That would change everything.
oh yeah, that would likely trigger a severe broad-based sell-off in the US dollar. That's the key counter-narrative to watch for.
Oh, say. So, as you, our listener, digest all this information, maybe here's a final thought to mull over.
Yeah.
In a world that seems increasingly shaped by, trade policy, geopolitical shifts, things outside of traditional economics,
Yeah.
how much will central bank independence truly define monetary policy going forward?
Interesting question.
Or will these external forces continue to exert a growing, maybe even dominant influence on where interest rates actually end up? Something to keep digging into.